So submit questions for panelists as the conversation begins. Submit questions to us at RFK. And if you're having technical difficulties, please submit those questions through the chat box or email us directly at compass@rfkhumanrights.org. We'll be monitoring that throughout the session. The webinar will be recorded, so you are being recorded, and this will be distributed and available post today. So just wanted to keep that in mind. And last but not least, the most important piece is we could not have done all of this without the support of a number of people. And I just want to pause for a second and thank our sponsors this year, or underwriter sponsor for 2020, Vista Equity Partners, and a number of our influencer sponsors you'll see circulating on the slide. We could not have gotten to this point without your financial and time support, and specifically also our advisory committee this year, who have just been amazing in giving us their time and ideas, connections, as we've had to rethink how we continue to do our work with the investment community, with you. So I just want to acknowledge these two groups and say thanks. And with that, I'll turn things over to Kerry. Kerry, over to you. Kerry, I think you've muted yourself.
Now, am I here?
Yes.
Okay, great. Sorry about that. First of all, thank you, Sansia, for all of your help and leadership, to everybody at Compass and to our entire Compass team. And a special thanks to Marvin Rosen, our board member, who's our Compass guru. So before we dive into the conversations today, I just wanted to bring everyone up to date on some of the work that we've been doing here at Robert F. Kennedy Human Rights, especially around COVID and racial justice. Before I begin, a special thanks to Mike and Jim and David for leading us in what will be a wonderful discussion in just a few minutes. At RFK Human Rights, everything we do begins with my father's values and vision. And on April 4th, 1968, he addressed what was a majority Black audience in downtown Indianapolis. And he had to tell them the dreadful news that Martin Luther King had been killed. That night, riots broke out in 125 cities across the United States, and Dover, Delaware was under martial law for the next 9 months. The next day, the white establishment immediately reacted by saying they now, because of the looting, they owed nothing to the Black community. And so my father wanted to challenge that notion, and he gave a speech at the Cleveland City Club, which was a bastion of white power. And in that speech, he said that the structures of power upon which these men sat were built on institutions of the anti-Black racism, and that riots were the inevitable outcome of structural racism, and that they had a duty to dismantle structural racism in our country. I just want to show you a 2-minute clip from that speech. But before we show the clip, I just want to say there have been a lot of showings and reshowings of anti-Black violence in the last few months. If that's hard for you to watch, then you might not want to watch this video, because it's tough.
Whenever any American's life is taken unnecessarily, whether it is done in the name of the law or in defiance of the law, whenever we do this, then the whole nation is degraded. And yet it goes on and on and on in this country of ours. Too often we excuse those who are willing to build their own lives on the shattered dreams of other human beings. Some accuse others of rioting and inciting riots have by their own conduct invited them. This is the violence of institutions, indifference, inaction, and decay. This is the violence that afflicts the poor, that poisons relations between men because their skin has different colors. This is the slow destruction of a child by hunger and schools without books. This is the breaking of a man's spirit by denying him the chance to stand as a father and as a man amongst other men. We learn at the last to look at our brothers as alien. For when you teach a man to hate and to fear his brother, when you teach that he is a lesser man because of his color, then you also learn to confront others, not as fellow citizens, but as enemies, to be met not with cooperation, but with conquest, to be subjugated and to be mastered. We learn to share only a common fear, only a common impulse, to meet disagreement with force. But this much is clear: violence breeds violence, repression breeds retaliation, and only a cleansing of our whole society can remove this sickness from our souls. We must admit the vanity of our false distinctions and learn to find our own advancement in search for the advancement of all.
Thank you. You know, that video reminds us that although there are many things that have changed over the last 50 years, there are still extraordinary human rights challenges in our country that we have yet to address. And that's really around institutional racism. We have deep anti-Black racial divisions that we've never addressed, from police violence to the criminal legal system, to the system of financial inclusion, exclusion, and the other structures that are underlying the social and economic conditions that allow racism to persist. We have this against the backdrop of a global pandemic, which disproportionately impacts communities of color and deepens wealth inequality in our country and around the world. And then we have the Trump administration unleashing military and police on protesters, on peaceful protesters, and sending a clear endorsement of anti-Black violence domestically, while signaling to oppressive regimes across the world that it is okay to use military force against peaceful protesters, to countries like China and Hong Kong, Myanmar military against the Rohingya, and the Venezuelan military against the indigenous populations of the Amazon. So just as my father worked to address these issues in our country and around the world, that's what RFK Human Rights is doing today, and that's what the Compass program is ultimately all about. The core of our domestic work is around criminal legal system reform, and our approach is very simple. It's first to listen and be educated by the people who are on the front lines, because we believe that those closest to the problems are closest to the solution. So we are working across the country with Black-led organizations on police violence and criminal justice reform. Many of the people who we work with are formerly incarcerated or have deep personal engagements on these issues. And we are working with frontline advocates to end money bail, to decarcerate local jails, and to roll back mass incarceration. So what do we do? For instance, during COVID, we partnered with local bail funds who are doing this work day in and day out across the country. We orchestrated 12 bailouts of people whose lives were at risk of COVID that were rampaging through jails. An example, we bailed out one woman who was put in jail and had $25 in bail that she could not pay for unpaid parking tickets, and her life was at risk. That's what we are doing in this country to people. We bailed out over 100 people. And this is so important today because if you take a map of the jails and prisons in the United States and you superimpose that on a map of where the biggest outbreaks of COVID are coming from, they are exactly the same map. So we're doing that on one side. On the other side, we're supporting young leaders in classrooms and college campuses across our country to become human rights defenders in their own communities through our education program called Speak Truth to Power. We've established a Young Leaders Defenders Fund and series of guidance to support young leaders to engage in protests against police violence in their communities. And I'm so proud to say that one of our groups of young leaders at Texas State just helped local advocates pass the first cite and release law in the state of Texas to ensure that whole categories of people will no longer see jail time and instead will just receive a notice of when they need to appear in court. And then, of course, we work with the investment community to drive towards racial equity. As you know, across the $70 trillion worldwide investment industry, less than 2% of funds go to women and minority-owned firms. And under Marvin's leadership, RFK Compass is working with John Rogers and Mike Posner and our partners at NYU to address this disparity and people in the Compass community. We are convening leaders at the universities with the largest and with the 30 largest endowments in the United States to redirect their investments consistently with their diversity values. We are urging the investment world to use income inequality as the universal measurement of the S in ESG. Next, we're in discussion with leaders in the investment sectors about concrete steps they can take to address racial and economic justice. In the United States today, the racial wealth gap is staggering. Median household wealth for a Black family in our country is $17,000. Median household wealth for a white family is $171,000, 10 times as much. That is unacceptable. And the investment community can do a lot to address that. Last Thursday, together with 128 socially responsible investors, we issued an investor solidarity statement on racial injustice. And it was picked up by Bloomberg and Barron's. And we give people specific things that they can do. Later this week, we are issuing our 5-point action plan for investors to address racial justice in this sector. And we urge you to really take a look at that and to spread it far and wide within your community. I'll just give you a couple of examples of the types of things we're urging people to do. One is screen out companies in your portfolio whose business models, products, and practices actively support the racist criminal legal system, such as supporting predatory lenders and private prisons. 2, offer paid time off with healthcare coverage to contract and part-time workers who are essential to business operations. 3, challenge portfolio companies to place 5 Black leaders on their boards over the next 12 months. And 4, invest in community development financial institutions owned by Black, Native American, and Indigenous groups. And I just have to say that for me, this last one is especially important, personally to me, because my dad, Bobby Kennedy, started the first community development bank in the United States at Bedford-Stuyvesant, Brooklyn, which was one of the largest slums in America in the 1960s. And that organization continues to this day. So if you're trying to figure out which one to invest in Bed-Stuy. Meanwhile, our day-to-day work protecting and honoring journalists and working on international human rights continues. So we are doing all this work. I'm happy to say that our seminal report on the systemic use of disappearances and extrajudicial executions by the Maduro regime in Venezuela was the front page above the fold of the New York Times international section day before yesterday. And we're working on cases across the globe. Our work is possible because of your support. So I want to thank you all again for being part of the Compass community, for donating your time and through your wallets and making this possible. Look forward to today's conversation. And if you want to become more engaged in our work on social justice and racial justice, we're looking for partners. We're looking for help. So please get in touch with me or Sansia or Marvin, and we will get you engaged with us. Thank you so much, and thanks again for your support. Okay, Mike, over to you.
Thank you, Carrie, and thank you everyone for being here today. It's unfortunate that today was the day we were supposed to be in Hyannisport, but at least through technology, we can address some of these issues, at least over Zoom. So with that, before we tackle some of the topics that Carrie mentioned, first, I want to check in with Jim and David. It's been an interesting few months. We have a global pandemic. The world has been shut down, reopened. The waves are going around the world. We're all starting to work from home, or we've been working from home for a while. But in the meantime, the investment process must still happen, right? We're all still fiduciaries. We're all overlooking pools of capital on behalf of ourselves and our constituents. I think before we get into the meat of the discussion, I would check in with each of you first and say, well, how are you? How are you doing working from home? And how's the process working on your end? And I guess I'll just go to you first, David, because it's alphabetical.
Yeah, Mike, thanks. So we're probably, like most folks, counting by the week. I mean, we're in week 14 working remotely. And I would say, like, for the New York City retirement systems, our private equity team consists of 6 professionals. And I would sort of describe it as we haven't really missed a beat. And I think it's because the team has taken the approach of kind of leaning into the workload, I don't know, 115, 120%, kind of over communicating internally, because precisely since we're not in the office and the information flow is less fluid, we're doing simple things like, like most folks doing weekly update calls, but also copying everyone on the team in communications where sometimes it would just be the coverage team for a specific GP relationship. But in the wake of the COVID crisis going remotely, we find that kind of making the effort to get the information to everybody, just kind of helped us work better together. So I think we're, on track. I think we've been just as effective in executing on fund commitments and strategic initiatives remotely as we would have if we were in person.
Jim?
Thanks, Mike. But firstly, I might mention that anything we talk about pales compared to Carrie's wonderful introduction, raising huge issues, which, although we're in Canada, are obviously relevant to us as well. But that was a wonderful start. It just occurs to me that when we talk about challenges of working remotely, that I should probably mention to people that some context in terms of the Canadian model, because there's quite a difference between Canada and the United States in the work we do as private equity groups. The Canadian model has been to build teams inside these pension organizations that, in some cases, in one case in Canada, the group does only direct investing, so they act entirely as a private equity fund. In our case, our team has decided strategically that we'll do both. So we have part of our business making fund commitments and part of our business investing directly, just as a private equity fund does. And some of our investments are around the world, some are in the United States. A couple of them would be known to you. So we have both types of work going on. And because of that, working remotely is working just fine from the perspective of making fund commitments, but it's a little more difficult in doing direct transactions. We have a couple on right now, one of which is a business where the head office is in Seattle. They've got part of their operations in Alaska, another in the Midwest of the United States. One of our large investments is a multi-billion-dollar investment, has a head office that we moved to Boulder, Colorado. Although I initiated that move and we've set up a management team down there, I haven't yet been able to visit the office. And in doing due diligence, we were just on a group call this morning about how difficult it is to do what we'd normally do, which is go to other people's offices, go to their manufacturing facilities, and just get a better sense of the business that way. So there's no doubt that that part of our business is more challenging.
So Jim, that brings up a good point. Obviously, usually if I think back to the GFC, this is where we would normally talk about the denominator effect, how it's impacting portfolio construction. If you look at the public markets, miraculously, there is no denominator effect. And people, and I have to give credit to the LPs this time around, most of them manage their capital well. They didn't get ahead of their skis from a cash flow perspective, with the exception of maybe some smaller endowments and foundations that have, I would say their issue is more a revenue problem than an actual denominator effect problem. But is your pacing still on track? Are you changing your portfolio construction? Are you looking at, I mean, everyone talks about the haves and have-nots because it's hard to do an investment that you haven't met with someone. And maybe I'll toss this at you first, David, and then I'll come back to you, Jim. How are you thinking about that pacing and investment process when you are clearly stuck in your house and so are the rest of us?
Yeah, I think, I think back to the first 2 or 3 weeks when we went remote, kind of call it mid-March till the end of, or into early April. And we were a little bit in like crisis management mode because, as we all recall, the public markets were showing like signs of extreme downward volatility going into the end of the first quarter. So if we go back that period of time, no one expected really the swift, kind of equity market rally that we're seeing today. So in that initial period, we worked with our private equity consultants to run a series of kind of scenarios and pacing analysis precisely to kind of be as thoughtful as we could. And I think where we are shaking out is we are more or less on track to pace in our 2020 commitments, similar to a similar range where we were when the boards approved our pacing plans in the fourth quarter of 2019. So I think we're kind of on track. And the way New York City is approaching it, which I think is, was a strategic shift and a lesson learned from the global financial crisis is, we have a pacing target and sort of a zone or a band of private equity exposure, where our trustees are comfortable and where we can be investing. So it's not like there's one hard number where, if the public markets have a decline, it automatically triggers, the need for a secondary sale or some sort of, massive rebalancing.
Jim?
Thanks, Mike. So again, some context is that we're very fortunate in that we're 103, our funded ratio is 103%. So when we hear of the United States pension funds being often 60, 70, 80% funded, that's just such a different world for us than the world we live in. So we're in a very fortunate position to be fully funded, and that hasn't changed dramatically. Even at the bottom of the market at the end of March, we were still over, our funded ratio was still over 100%. So we're more conservatively funded. Pacing is an interesting topic because we don't pace, we don't subscribe to pacing. We think there should be zero pressure to deploy capital. And so, and that's one advantage when you think of the private equity industry dominated by funds with limited life. We obviously don't have a limited life. And so our culture is one where if our investment teams didn't deploy $1 for 2 or 3 years because they didn't think there were good market opportunities, that would be just fine. And that applies to the groups I oversee are private equity, infrastructure, real estate, private capital. And that's the same for all those teams, even though our hope is that we will build up our assets under management in each one of those. There's zero pressure to deploy capital. And I think, I'll just pitch that for 15 seconds. I think it's a better model because obviously, and I in my prior life ran a mid-market Canadian private equity fund, and I tried not to be influenced by the limited life of the fund, but we couldn't help but be influenced. I remember we went for over a year not finding anything we thought was an interesting investment opportunity. And it for sure influenced our perspective on investments. And so that's not the world we live in. Now, one thing though I will say about the private side, I think 2 things have happened. Firstly, because of central bankers, United States and around the world, fiscal policy, we seem to be living in a world where everybody is agreeing that there should be close to 0 interest rates for the foreseeable future. I think your chairman of the Fed was just on a call last week. One of our team members was telling me, and he was basically saying that cares now only about improving employment prospects, and the only way to do that is to keep interest rates where they are for the long term. So if that ends up being in fact the case, then we have to look for returns. And so that causes us to want to continue to build up the private side in all the areas I've mentioned. So there's certainly lots of appetite on our part to do that.
No, that is very true. And even those that aren't, you're in a nice position of being fully funded. Those that aren't are even striving more so for these returns. But in the process, I will say over the last few years, originally I would be asking you about the ESG part of your process. But I will say with the climate issues that we've had recently, the E issues, obviously the systemic inequality issues, how is that impacting your process and your thought process during investment? Because remember, you as allocators tend to drive how those that are allocated to operate their businesses. So in this, what are you doing specifically, I should say, I guess, from an ESG perspective to either promote some of these initiatives or track them or try and motivate that type of process?
Mike, do you want me to start?
Sure.
Okay. And as I was listening to you, it reminded me of, because I could talk about this as is the case with many areas of private equity for a long time. And my wife, when we were putting our books down, ready to go to sleep, said to me just a little while back, she said, "Could you please start talking because it'll help me get to sleep?" And so I'm concerned about going on too long about any of these topics. So Mike, just jump in.
I think I can mute you, so don't worry about it.
Okay, perfect.
Go ahead.
So on the ESG front, you start with the fundamental point about whether it's a screen or just a screen, or whether you should be proactive. And let me speak to both. And it's not in our shop about process, because I've seen how process can lull people into making bad decisions. And so for sure, there's a screen in what we do on the direct side. And I'll distinguish that from fund commitments. On the direct side, when Carrie mentioned predatory lenders, I thought of a city subprime deal where the essence of the business was lending to people who were financially illiterate at rates that are just not reasonable in this world and can cause people to dig themselves into a hole. And I know the arguments in favor of subprime lending, but I think they're weak compared to the arguments that it's not helpful to people who need that sort of financing. And so we looked at that and we said, do we really want to be involved in a business that fundamentally is preying on people who are financially illiterate? And we said no. That's an example of a screening. I can tell you there's a very major world-renowned Canadian pension fund that had no problem with it. And it was interesting, when I spoke to the head of that private equity group about it, I said, look, with your ESG processes, how could you really, with a clean conscience, get into that? And the person said to me, well, we did. We looked at net promoter scores and it was fine, and we followed all our processes. Well, net promoter scores were developed by Bain about 20 years ago, and they basically look at customers, and they see in the consumer space, and they survey customers to see if customers are satisfied or not. So how could someone look at a business, survey those customers that are being taken advantage of who don't know any better, and sort of say because they're happy, it's therefore okay? But I think that's an example of where a process caused them not to look at the essence of the deal. And so we were pitched in the last few weeks about a lottery business, and we decided that we didn't want to be in that business. There's a casino-focused private equity firm where when I came in, it had been a long-standing relationship, and we decided we didn't want to be in that business. Cannabis obviously is legal throughout Canada, and even though that it's legal, we said with the wealth of opportunities available in the world, why do we want to be in that business? So we for sure use it as a screen, but we do it from a common sense rather than a process perspective. Now, fund commitments are a different area, that side of our business. And there's no doubt that when you look at all the private equity firms around the world, they have ESG policies, but I think a little bit of it is to basically satisfy the capital providers that they have ESG practices. Not in all cases, but in some cases, I think there's a lot of lip service around that. Now, in terms of moving to investing, which is more, back to investing, which is interesting. Carrie, I think, mentioned the S in ESG. On the income inequality or wealth inequality front, we are looking at something right now that's US based, where you have a system down there that we don't have in Canada called ESOPs. And there are tax advantages in making a company an ESOP. And for those on the call who aren't familiar with it, it's basically passing ownership of the company to employees through a trust. And we're looking at a situation that would keep a company employee owned and would as well be an interesting investment opportunity. So basically a double bottom line. And it's an interesting business. The financial terms are attractive, and it has a very nice social side to it because of, in a small way, keeping the wealth accretion, if the business does well, in the hands of principally employees. Now, we also have more modest return expectations. And so we can provide financing on terms that are a little better than market. And so we're less extractive in terms of our capital. But that's an example of where, you know, we do find that aspect of the transaction attractive.
So I will say on the plus side, over the last 7 years I've been at Stepstone, it was rare before, but it's now quite common for us not to approve an investment for ESG reasons. And we've got a much more elaborate due diligence questionnaire and kind of a rigorous analysis that we go through that we didn't do 7 years ago. So it's a positive move in the right direction. I mean, I find it fascinating, even today, some GPs still come to us and don't have an ESG policy. So, I mean, it's almost incredible. David, maybe I'll give you a chance to talk about this as well.
Yeah, thanks, Mike. I think, I think in New York City, probably since, 2016 or so, we've, had a focus on diversity. And so when we do diligence on our managers, we would try to understand, ethnic, gender diversity at the firm, among the investment staff, understand, and it's not just a numbers game. It was also, in our kind of due diligence questionnaire, and when we do our on-site, we try to understand what is the GP's thinking around the issue, right? Are they aware of the benefits of having a diverse team, or are they not? And my experience, I've been in New York City for 4 years. I've seen like two ends of the spectrum. I've seen, some GPs who say, we don't really think about diversity. We just want the best candidate, right? When we're hiring, you often hear that, right? It's whether it's a woman or a person of color, we just want the best person. And then on the other end, we have, some GPs who have very, proactive policies where they'll have, from a gender perspective, fly, no fly policies for new parents. They'll provide, very generous parental leave or family leave. They'll be LGBTQ diverse and track those numbers. So we've seen the whole spectrum. We don't have and the GPs who may be on this call, they know this, right? We don't have targets. We don't have a cutoff. What we try to do is emphasize to our partners that this is something that's very important to us as an LP, and we want to see how they think about it and see how they improve over time. So as I was mentioning earlier to somebody, that at New York City, my office is the fiduciary advisor to 5 plans. We don't make the decision. We make an investment recommendation to 5 boards, and the boards interview the manager and approve or don't approve our recommendation to commit capital. And at these board meetings, every GP seeking capital from New York City, they're required to address diversity and ESG. And we've had trustees say to them, okay, well, we understand this is how you're doing it today. When you're back with your subsequent fund, we want to understand how you've improved. You're telling us today you're trying to be better and you recognize the industry is far behind, on a range of these topics. But if you want to re-up from us, we're going to ask you, how have you improved over the past 2 or 3 years since you were last in front of us? I will say, just sort of personally, just to reflect upon, the question and Carrie's introduction, when I think about the work that we do at New York City, right? We ask about diversity, we ask about ESG, it's in our memos, the managers present. I think the challenge is, right, or the right way for us as LPs or an industry to think about it is, like, we can't have one lens that we use, you know, in these past several weeks to look at the social injustice in our political and social systems, right, globally, and have a different lens when we look at our industry, or we look at our investment partners, or when we look at our own institutions. And I think that is, you know, we're in this sort of moment in time, or let's say private equity, private markets, GP-LP relationships, where I think it'll be something for us closely to watch and follow. But I think we really need to have sort of one standard, because you can't sort of, you know, watch the news in the evening or read the newspaper, but then sort of have a different standard when you're, you know, looking at your professional relationships.
That's more than
interesting,
fair.
David. Mike, can I, maybe I can just add something on the diversity front, because that's something that we have a very diverse team to start with. And we've been fortunate because, well, Toronto, we're lucky living in Toronto because Toronto is one of the most diverse cities in the world. So it's part of our culture, but our team is very diverse. But the Black Lives Matter movement has caused us to talk about it over the last few weeks. And it's interesting, and we've talked about how do you define diversity, and we talked about it's one thing to have hiring processes that assist us coming up with a diverse group, but it's also another thing to provide equal opportunity once people are working on these teams. And so this sounds like a very small point, but I'll mention it just because I think it's small in numbers, but if we could all do this, I think it would help. So we've said, how can we do something more than simply give lip service to this? And how can we do something more than simply, when we get applications for jobs, make sure names are whited out or any indication of background, gender is blanked out in the initial screening process. So we talked about the problem in private equity. And the problem in private equity in America and in Canada is the funnel, the hiring funnel. At least that's how our team thought of it. We said the problem is that generally we hire people with investment banking backgrounds, major consulting firms, sometimes other private equity groups or fund of funds groups. And the problem is that there's not a lot of diversity there. At least that's what we've seen. And that applies to, by the way, not just to people of color, but also women. And so that's challenging because when we conduct searches for people, we don't get a diverse group applying for jobs. So one thing we said we were going to do, and we can't implement it this summer, but we're going to do it next summer, is we're going to go to Canadian universities and we're going to, we've never brought in summer interns because our business, they aren't helpful, but we've decided we're going to start summer internship programs for people who are diverse. And so when we talked about it at the last meeting, we said we're going to define diversity, rightly or wrongly, as people of color and Native Canadians, because we feel like in terms of leveling the playing field, those are the groups that maybe need the most help. And we don't have data on this, but that was just our judgment. So we're going to start with specific summer internship programs, which we've never done before. We're going to make them worthwhile. And we're going to keep going with that, hoping because those people will then be able to be more likely to get into investment banks, be able to get into the jobs that may ultimately funnel into private equity.
No, that's great. There are a number of organizations here in the US that also try to promote that type of sponsorship activity as well. I think now I'll toss it back to you, David. I mean, look, because of all of these issues, whether it's COVID, us working from home, new process, we've got all these ESG issues, people are starting to focus on their portfolios a little bit more than they have in the past, right? And so far up to this point, we've talked about kind of the sourcing, screening, and diligence process. What about everything after the commitment? Are you monitoring your companies differently? Are the GPs responding? I don't know about you, but I get emails from GPs constantly, and they want to give me their latest update. How are things different on your end? How's that post-commitment portfolio monitoring changing given this environment? Maybe I'll just toss it to you.
No, absolutely. I think sort of in summary, it's definitely more active portfolio monitoring. I mean, I think it was probably 10 weeks straight of multiple COVID update calls, and then kind of first quarter flash number updates, right? I mean, we were, like many LPs, very focused on what is the impact going to be on first quarter financials and valuations. Even though COVID, at least say call it North America and Europe, really just caught the last half of March. So I think that, from our perspective, it's been more hands-on with multiple and more frequent interactions with our existing managers since we've gone remote. I think it's been helpful. I think it's also the other thing we've noticed as an LP, and I'm sure we're not alone. I know we're not alone. Is the number and the range of consent requests we've received from GPs, who are trying to manage liquidity for their portfolios. So sometimes it's been, reducing certain restrictions, whether it's, geographic constraints on on follow-on investments, or in other instances, it's extending recycle periods so they can, if they get liquidity for one of their investments, use proceeds to support existing portfolios or for accretive add-on acquisitions. So we're trying to look closely at those solutions. It's a challenge because you want to be supportive because you have dollars in the ground with a GP and their fund, but we also want to be prudent about how much flexibility we give to our managers. And I don't know, Mike, you guys have probably seen that on the consulting side, and Jim as well.
So are you changing your return expectation for these funds as well in this environment? Or is it, I know let me back up to a comment I made before. I think LPs have done a great job preparing themselves for what happened. They didn't know this would happen, but they knew something was going to happen. So that portfolio construction was preparing for this. I think GPs, on the other hand, to your point, a lot of amendments, a lot of consents, GPs that have used up the majority of their capital in their portfolio or they're unfunded need to figure out ways to save their portfolio companies. Is that hitting your return expectations as well?
Like for new commitments or recent commitments, we have the same return expectations, right? We're shooting for, gross mid-20s or, kind of low 20s, high teen net IRRs to us as an LP. For the older portfolios, the older funds, I think it's sort of facts and circumstances, right? It depends on the quality of the portfolio they're trying to support. And it's dynamic. I would say for the New York City private equity portfolio, we, from our existing managers, the range of valuation impact that we've seen for first quarter numbers, and this is sort of just the range, has been from, let's say, single digits, like 7% decrease from 12/31 to kind of 20% plus, right? And the 20% plus may be, sort of idiosyncratic where there was some energy exposure or travel and leisure exposure. So there is that range, but it's sort of, I would say maybe, at the end of the first quarter, I was very cynical saying, let's see what second and third quarter looks like when you see the operating impact of not just the pandemic, but the ensuing recession. But as we get these more frequent updates from our GPs, it's quite interesting because it feels like it's going to be puts and takes where like some funds may actually do well with their second quarter valuations and others may be impacted more. So I feel like there's no real way to generalize. Whereas maybe 3 or 4 weeks ago, I probably would have generalized that second quarter would be worse than the first. Jim, I don't know. I'd be interested to hear your perspective because you also have a broader point of view because you manage more than private equity.
Yeah, and though what's interesting, David, I agree with you with your last comment in that it's hard to generalize. It's very difficult to know in some cases. And I know one of our Canadian peers, for example, has a large investment in a UK-based movie theater chain. And how can anybody have any idea what that is worth? It's been shut down and you don't know what will happen when it comes back. There's another, just recently, someone very well known in the United States who owns some iconic sports teams came to us because their hospitality business needed money. And they were prepared to, and you couldn't put a value on it. And they knew that, impossible to value. So they basically were saying, look, we need to keep this going for at least another year until these sports teams hopefully come back, and we'll be prepared to pledge real estate with 2 times coverage, low teens return, just to get capital for our hospitality business. Now, as it turned out, we thought that almost sounds too good to be true. And then the US government stepped in and is offering support more generally that this group could tap into. And so they obtained a few $100 million from basically the government. But, just as I mentioned that, I'll give an example of our pet food company, the one that is headquartered in Colorado. We talked about whether or not we would access the US government programs for some aid. And this is a case where the company, its financial performance has improved during COVID because everybody still needs to feed their pets. It hasn't been, and this company operates around the world. We operate in 80 countries. And so we decided that the right thing to do is not to access those programs. Now, I don't want to appear too self-righteous because the dollars were also meaningless. It was a few $1 million, and we just said, look, it's the wrong thing to do. It could also come back and haunt us. I think I read that Harvard in the US ended up returning some money, $10 million or thereabouts, that they had received or could receive through the government aid program. So I know in that case we decided not to access it. But turning to our direct investments, we've also seen, we're fortunate with our portfolio makeup because we're in some food businesses and we have no hospitality exposure. We do, though, have 2 smaller exposures. I can mention them. One of them is a small coffee shop operator. It runs coffee shops called La Colombe in the US. And it was part of we have an investment in Chobani. We took TPG out of Chobani Yogurt, and the founder of Chobani also has a controlling stake in this coffee chain. And so obviously that business is completely shut down. There are 2 main parts to it. They run coffee shops and they also provide coffee to the hospitality sector. And how do you put a value on that in providing capital? So you tend to go up the balance sheet. We have provided additional loan facility to hopefully take them through this. But if you were to try to value the equity, I think it would be impossible because we don't know what those businesses are going to look like. If they end up only being able to operate at 50, 60, 70% capacity, then who knows what their businesses will look like. The last thing I'd say, though, about this whole area is that we have encouraged, David, when you mentioned your return expectations, ours are more modest. We don't expect 20s. We expect low double digit. And we as a team, when we sat around and did strategic planning, said, look, if we can over a 10-year period get an 11, 12% return, we'll feel terrific. And so that's kind of our target. And funds, we're perfectly happy if they're teens and on a net basis to us low teens, which also means it probably helps us create a culture too of the long term. You don't have to be too aggressive in what you do with the business. We want just businesses to grow over a very long period of time and achieve reasonable levels of return.
David, I think at this point, I'll toss it to you to close out, and then we'll open up for any questions because we've actually hit our time limit today already. But with that said, I guess first, David, I know you're not supposed to time private markets. We tell everyone not to, but everyone tries anyway to lean in, at least in some way, into this opportunity set that presents itself to us right now. Is there anything in particular that you're, I'll go back and I'll say leaning into in your portfolio construction?
Yeah, you know what? It's something that I'm going to go back to what I've said, maybe hopefully consistently for the past couple of years since I was promoted to head of private equity. And it isn't necessarily thematic, but it's one thing we focus on in diligence, and that is the operating capability of our GPs. It's sort of, the way we've thought about it is there's a range of capabilities, and we see, in-house consulting firms, we see, kind of smaller teams who are managing specialist consultants externally. I don't think there's a right approach, but when we were leading up to this, call it into the, throughout 2019 and heading into the beginning of this year, we were always asking the questions in diligence, sort of, do your operating teams, in addition to, helping to increase sales and, kind of investing in the company, do you have the cost cutting capabilities? Do you have the resources internally or externally to manage levered assets in a crisis? And, we're LPs, right? We're not operating executives ourselves. We want to make sure that our partners have those capabilities. And, the good news is we do have some long time relationships with managers where, their portfolios have either been fairly resilient or we've been, pretty impressed with the way they're handling this crisis. And I think that's one of the things we're going to look at as we continue, whether it's a re-up to an existing manager or looking at a new relationship, is understanding, those operating capabilities.
Great, thank you, David. I think we've tried to answer some of the questions as we go along, but I think if there are no other questions, either type them in or I will pass it on to Sansia.
Thanks, Mike. Maybe what we could do is just open up the lines to see if there are any final pressing questions from folks, if they want to just chime in. I did see one question here about COVID, which I think we answered. Steve DeSherney asking, how have we changed due diligence on direct investments due to COVID? I think we touched on that to some degree. So if there are any final questions from the group, otherwise, just give that a few minutes. Otherwise, a couple things I just wanted to mention. Tomorrow, we'll be kicking off a race and wealth series. We're doing tomorrow's call in partnership with a group called Handshake. Two of our board members, Sasunda Brown Duckett from Chase and John Rogers from Ariel Investments, will be joining us in a conversation with Kerry, the mayor of Arkansas, the mayor of Little Rock, and Jeff Robinson from the ACLU, who will be in conversation around some of the disparities we see in the business sector broadly on race and economic inequality. This will kick off a 4-part series that we'll be launching throughout the summer on race and wealth. The other thing I want to mention is that our RFK Compass Live is not a one-off activity. This will be a core engagement platform for our organization going forward. So you can be on the lookout for sessions coming up over the course of the next several months, throughout the rest of this year and into 2021. So with that, don't hesitate to reach out to us. Email me, email my team with ideas of speakers. If you yourself are interested in joining us in a discussion, or you'd like to brainstorm with us to build a session together, we are open for all ideas and are willing and ready to collaborate with you. So wanted to mention that. We'll share the details about tomorrow's call with you. This one came together rather rapidly. The video from today's call will be shared in our follow-up note on Thursday, in addition to the links to the statements that Carrie mentioned on the call. We want to hear your feedback. RFK Human Rights Compass doesn't push lightly, so we know there will be lots of feedback coming out of that. But we really would love to continue the discussion with you on this. We will also be releasing our schedule for July for our investor dialogue, so look out for that towards the end of the month. So I think with that, there is a question here, last thing from Ralph Money at the Common Fund. Last word, can you share your respective points of view on private equity in the environmental sustainability area, PE returns and measurable impacts on our common shared environment? If there are any final comments there from Jim or David, otherwise we can send a quick follow-up with Ralph on that. I'll give you guys the final word.
Sorry, David, you go ahead, and then I'll.
Yeah, so I'll be really brief. Ralph, thanks for the question. So New York City, our comptroller, who's the head of our office, and then a couple of two of the largest of our 5 pension systems did announce a goal in a press release to double our exposure to climate change solutions investments across all of our strategies. So that's public and private market strategies. And so that is something that all the asset classes are actively working on. So I'll ask maybe Santia, you happy to have Santia connect us and we could have a follow-up discussion.
Yeah, and David, I'll just add to that. I think I wouldn't be fill the Canadian stereotype if I didn't apologize. So I will apologize for the fact that we have not been strong on this, and I personally haven't done a great job on taking initiatives on this round. It's obviously a screen. In my previous construct, I talked about the difference between screening things and being proactive. We have thought about it from a screen perspective when we look at direct investing, but we haven't yet moved to a level where we're being more proactive on it.
With that, Santia, I think it's a wrap. Thank you.
It is.
And thank you, Jim. Thank you, David.
Oh, thank you all.
To everyone.
Great.
Appreciate
Thanks,
it.
everybody.
Take good care. Bye.
Bye.
Bye.